Hello everyone. In this video, we will discuss about understanding interest rates. So what is an interest rate? The interest rate is the amount a lender charges a borrower and is a percentage of the principal, the amount loaned. The interest rate on a loan is typically noted on an annual basis known as the annual percentage rate APR. Understanding interest rates. Interest is essentially a charge to the borrower for the use of an asset. Assets borrowed can include cash, consumer goods, vehicles, and property. When the borrower is considered to be low risk by the lender, the borrower will usually be charged a lower interest rate. If the borrower is considered high risk, the interest rate that they are charged will be higher, which results in a higher cost loan. Simple interest rate. Let's look on the formula for finding simple interest. Simple interest is equal to principal into interest rate into time. Compound interest rate. The following formula can be used to calculate compound interest. Compound interest is equal to P into 1 plus interest rate into n minus 1, where P is equal to principal and n is equal to number of compounding periods. Compound interest and savings account. When you save money using a savings account, compound interest is favorable. The interest earned on these accounts is compounded and is compensation to the account holder for allowing the bank to use the deposited funds. Borrower's cost of debt. While interest rates represent interest income to the lender, they constitute a cost of debt to the borrower. Companies weigh the cost of borrowing against the cost of equity, such as dividend payments, to determine which source of funding will be the least expensive. Since most companies fund their capital by either taking on debt and or issuing equity, the cost of the capital is evaluated to achieve an optimal capital structure. APR versus APY. Interest rates on consumer loans are typically quoted as the annual percentage rate APR. This is the rate of return that lenders demand for the ability to borrow their money. The annual percentage yield APY is the interest rate that is earned at a bank or credit union from a savings account or CD. This interest rate takes compounding into account. How are interest rates determined? The interest rate charged by bank is determined by a number of factors such as the state of the economy. A country's central bank sets the interest rate which each bank uses to determine the APR range they offer. When the central bank sets interest rates at a high level, the cost of debt rises. The cost of debt is high, it discourages people from borrowing and slows consumer demand. Also, interest rates tend to rise with inflation. Economies are often stimulated during periods of low interest rates because borrowers have access to loans at inexpensive rates. Since interest rates on savings are low, businesses and individuals are more likely to spend and purchase riskier investment vehicles such as stocks. This spending fuels the economy and provides an injection to the capital markets, leading to economic expansion. While governments prefer lower interest rates, they eventually lead to market disequilibrium where demand exceeds supply, causing inflation. When inflation occurs, interest rates increase, which may relate to Walras law. So that's all about my topic about understanding interest rates. Thank you.